Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we are discussing new and off the plan and why we steer clear of all the shiny stuff. Typically, when you go and buy new and off the plan property, you'll pay over market value due to the cost of the developer that they dictate, which has to cover the cost of the land, labor, materials, tax, interest, holding costs, profit in the job. So typically you'll find new and off the plan stock getting released to a market towards the tail end of a boom where the projects become feasible. At this point of the cycle, it's not the best time to enter that type of cycle from the start, but you'll typically pay overs because the developer has to make a profit. They're not just going to give away their product. And if they can't sell it to make a profit, they typically just hold it, lease it out, and wait for the market to boom in order to offload and sell their stock. They also drip feed their product onto the market. So once all their stock is delivered to the market, that can also create an oversupply scenario, as typically property cycles start with a lack of property due to the construction property sector being stalled, like what we're seeing now down in Melbourne. Then the market tends to pick up and become a more balanced market, like in Sydney and New South Wales. And then when the market kicks off into a boom, like what we're seeing in Brisbane, Perth, Adelaide, that's when the price you pay will go above the rebuild cost or the new build cost. And that's when developers start releasing new stock onto the market and flooding the market with new property. Then the market will go through an oversupply scenario and then through a downturn. So when new and off the plan stock is getting released, you've already got the market selection wrong. Typically, they're negative geared properties, so 2%, 3% yields because the price is too high relative to the earnings. So that's another reason why we steer away from it, because if you go and buy this type of stuff, sure, you can go and save some tax if you're looking to negative gear the property against your income. However, the bank will then lock you up and you'll get stuck, like 99% of people who get into property investment. You need to stick to positive geared property and property that is self-sufficient. And that is definitely not what this new and off the plan stuff can provide. Minimal equity, if not any, when you purchase, as you'll be purchasing this type of stock in a booming market. Once the market softens, you could be left hanging for many years in negative equity, where the price you pay is higher than the actual market value. Therefore, you can't extract the equity until the next bull run, which could be 10, 15 years down the track. And you can even be left in a situation where banks can margin call. If you bought a unit for $1 million, $1.5 million peak market, and then the market then softens and goes through a downturn, which typically happens when all this new stuff is released to the market, and the bank gets wobbly and requires you to pay down some of your debt because the market value is less than what you paid. And if you don't have the cash to do so, then they can sell it, take their loan back, and sell it to the next person. So it is more of a dangerous product to definitely be getting into. And also risk of major builders going bust. We've seen it time and again over the last couple of years. The building game is a very tight, razor thin margin game. I worked for builders in my earlier stage of the career. We were pricing jobs at 0 to 1% margin and only making it up on variations to stay profitable. When margins are that tight and we've got elevated inflation elevated building costs, labor costs. It doesn't take much for a builder to find themselves running at a loss, especially if the job gets delayed by a couple of months, 6, 12 months. They lose money on these jobs. If they can't finish the projects and you've already paid your upfront deposit and even gone unconditional, you may not even receive your product or your property, or you may end up having a defective property, such as the stories in Sydney, the Mascot Towers, where dodgy developers went under, built the new building. When all the people went to load up their new furniture and loaded the building up, it started having structural defective issues. So then they weren't able to move in to occupy their property. They couldn't rent it out, and they still had a loan to the bank. So they are definitely a riskier product. They also come with higher holding costs. So with all the gyms, lift pools, maintenance upkeep, it does create the holding costs a lot more higher than the smaller boutique blocks that have none of the bells and whistles. So they can be very negative geared to hold. Yes, they look nice and shiny. However, with the sheer mass number of apartments, they lack scarcity. Therefore, when and if you go to sell, there may be multiple other properties on the market for sale or even for lease, so that it can create it very challenging to have long-term sustainable growth. As you can see in this 20 years of sales data, this is Docklands in Melbourne, but this is quite common for any inner city suburb that has a lot of high-rise apartment stock, as well as the Gold Coast. It can boom bust. As you can see, they had a big boom where we are now in the equivalent point of the cycle in 2006. Big boom up to the GFC. When the GFC hit, corrected as more stock was released onto the market in the lead up to the GFC. The market then stabilized, again came up to the big boom in 2017. A lot more developers released stock onto the market in 2017, 2018. We then had a downturn in 2018, the APRA credit crunch, and then also again in 2020 in COVID. So as you can see, it's a very volatile, up and down, unsustainable product to get into, because when developers release more stock onto the market, they flood the market with new units. Therefore, it can suppress prices for many years until the stock is soaked up with new buyers to push the prices higher. By that point, developers then release more stock onto the market again and then suppress the market. So it can be a very challenging type of product to build a sustainable portfolio, hence why we steer away from it. Typically, we like to buy the units, villas, townhouses in markets that are further out to the burbs, where there's a mix of houses, townhouses, mixture of stock, rather than very high density inner city high-rise apartments, as it can be unsustainable to build large sustainable portfolios for the long term. If this helps, shoot me an email. I can help you navigate the turbulent times ahead for not just markets, but also asset selection. It is critical to get your asset selection right, especially when starting off. It can put you out for many years if you get the wrong property up front. You can be left in negative equity. You can be left holding a property with very little cash flow and next to no growth if you don't get the key fundamentals right when buying property. Shoot me an email, send me some feedback. If you have any questions, queries around buying property, happy to help. Until next time, Thanks for watching.